If you walked away from your business for 2 years, would it be stronger when you return? That's the question that inspired generations of founders to build something that lasts. Running a business takes more than hustle. It takes a leadership team that anticipates what's next. A system that's well-oiled, self-correcting, and capable of growing beyond the founder. CBC Talks is about building businesses that don't just survive, but thrive.
All right, welcome back to another episode of CBC Talks, where we are looking at business owners and business leaders in the community for what they're doing in this and other markets. There's a big difference between a bank that processes transactions and a banker who understands your business. And too many owners in our world treat their bank like a vendor, and too many banks treat small businesses like a file in a queue. Today's guest is Brett Howells, currently of Riverland Bank, to talk about what relationship banking actually looks like, how underwriting decisions are really made, and why growth-ready companies need to deepen those conversations long before they need the capital. Brett, thank you for being here.
Thanks for having me. Glad to be here.
So one of the big distinctions and the reason why I was really excited about this conversation is having watched and introduced you to a couple of our clients, some of who've been in tough positions and some who've been in strong positions, watching what your relationship has looked like. What does that look like from your end?
Yeah, we generally work with small businesses, under about 30 million in revenue. A lot of those businesses don't have full-time CFOs or a professional bench to handle a lot of these things. So you've got a lot of owner-operator businesses that we work with. And that's kind of the sweet spot of, I think, where relationship banking really kicks in. And most banks that you'll talk to, a lot of them tout that they're relationship banks, but what does that actually mean? And I think, from my perspective, it means actually coming on the other side of the table and being a partner to the business owner and their management team, and kind of figuring out solutions with that in mind, rather than, the opposite mentality of being on the opposite side of the table and saying, I need money, you need money, and not kind of being part of the team, but kind of fighting each other on it. So, I think, what I like best about it is that I treat every client like I would treat a friend. They have my cell phone. And when there are things that pop up, we talk through it and we figure out ways to get through it. And, there's a lot of text messages that fly around and emails and phone calls, but just that level of responsiveness is fun on both sides.
So Brett, one of the conversations that comes up frequently in my world is like, I bank with one of the big banks, big consumer bank. And our question becomes like, well, how's your relationship with your banker? I don't have one of those. And you're usually my next introduction. What is it like for a business owner going from they're used to being just a number on a screen to now you're starting to ask them about their business and come on to the other side of the table as a partner? What happens in those conversations?
Yeah, there's a lot of skepticism usually, from those customers in that situation, where, they're like, gosh, I like kind of the security of the big bank and, fear of failure or, a smaller bank not having the technological capabilities or whatever it may be. But what's kind of funny about it is, at the big banks, a lot of times, and there's a place for big banks. I'm not going to sit here and rag on big banks. I actually worked for a large bank early on in my career, and I think there's a place for it when you are a W-2 employee and you've got a direct deposit paycheck and you don't really need anything other than convenience and ATMs all over the country. A big bank is a great fit. But when you're a small business owner and you've got things ebbing and flowing all the time, having someone that you can actually call on their cell phone as opposed to a 1-800 number is really the big difference. And, you think you have more security with a larger bank because they've got more capital to spend spend more technology, potentially more people, but it's harder to get through to the people that can actually make the decisions, right? So there's a lot of skepticism when we first have that conversation about how can you better serve me, and I a lot of times I don't have a great answer. I'm like, it's literally comes down to the relationship, and that's about it.
So let's talk about that mechanism a little bit. So you're saying you guys have a better app, right? And your back-end portals are all way better than the big banks, right?
Well, I'd like to say technology's come a long way. I think smaller banks do have a lot of good technology now, and the apps, can compete with the big guys. But yes, there's certainly probably a small, technology shortfall between the small banks and the big banks that I like to think we make up, with the people aspect of things, right?
So let's talk about some of the tools then. So when I introduce you to some of our clients, it's never because of the app of your bank. And it's not even necessarily because of how great Brett is. That's an easy sell. But there's other mechanisms and tools that your team is ready to be prepared with from an underwriting perspective of what you can do for some of these owners. So what are some of those solutions that you find are a pretty quick add that you start with a conversation with some clients? Like lines of credit, accounts, sweep accounts, things like that.
Yeah, good question. I think, a lot of people come in, and if they're at, I hate to keep using the example of a larger bank, but if they're at a bank where they're not getting, they don't have somebody that they can call directly that's educating them on what certain products are and what they do. For instance, what's the difference between a credit card and a line of credit? So, I just had a conversation with actually someone that you had referred over to me the other day. And, it's like, well, yeah, we use a credit card to kind of fund gaps right now, but we're growing and it's maxed out and it's getting harder to utilize that. What solutions do you have? And, when you bring up a business line of credit, a lot of times it's taking that extra step and educating, and it's like, well, okay, you're using the line of credit to fund gaps in business. So, whether you sell a product or a service, what happens is, you sell that, you have overhead, or if it's a product, you have inventory you need to buy. You sell the product, and then you get paid, in some cases right away, in some cases 30 days later. And a lot of times there's that gap in there. So you've got the overhead and the cost of the product or service that you've sold, but now you're not getting paid on it until 30 days later. So it's like, well, okay, simply you put a business line of credit in place to cover that gap. And, and then once you get paid on that 30 days later, in theory, you pay down the line and then you keep the profit, right? It doesn't always work like that. As you've got multiple customers and you're in growth mode, you're going to continue to have a balance on that line of credit. But that's I guess that extra step of education that, you've got to have a lot of times with people. A line of credit. Are you supposed to go and buy, if you're a manufacturing business, a piece of manufacturing equipment on the line of credit? Typically, no. We want to put that on a term loan because you don't want to jam up your line of credit. You want that available for your, usage when, you've got your normal cyclical business cycle. So that's one example of that conversation about, educating people on, how to utilize the line of credit, what that product's for.
How often do you find you're having to personally elevate the financial acumen and the stewardship of them, being entrusted with capital and the liability that you're presenting to them? How often are you having to personally raise them up to understand the responsibility of that tool that you're putting in their hands?
Yeah, I mean, when you're working with really small businesses, a lot of times people don't have a financial background. They have a product or service that they've developed or that they've grown, and they're really good at it. And, now they've gotten to a point where they're trying to scale a little bit, and, they do need some of that education. I don't like to look at myself as, going in and telling them something they don't know. It's kind of like, hey, there's multiple different avenues you can go. There's multiple different areas you can get capital from, whether that's a bank, whether that's private capital, or wherever it's from. And, I just do my best to try to educate and say, what are you doing? What are you building? And, how can the bank fit into it? Because sometimes the easiest thing for me to do and the best thing for me to do for certain customers is say no. And that's very helpful. I can educate and say, this is why this doesn't work, from a banking perspective. But, here's some introductions to some other folks that might be able to help you. If it's a startup that's scaling really quickly, for instance, bank debt might not be the best avenue for them or available to them. And they need some private capital or some investment funding or whatever it may be. And we've got folks that we can refer them to for that type of thing, externally as third parties. But, so it's just more each situation, every situation is different, and it's kind of like sometimes it's knowing when to say no right away, which is more helpful to them than dragging them along to the 11th hour and then finding out, oh gosh, okay, the bank can't do this, but I've just spent 2 months of my time and energy, and now I'm back to square one, right? So
let's talk about what the bank usually needs answered from their side. So someone might be a little skeptical of why should I go to a small bank? Like, what should someone be thinking about before they meet with a small banker to be saying, hey, I'm looking at changing relationships. How do they best protect yours and the bank's interest?
Yeah, it's a great question. Obviously I can go through the technical items of, yes, as much as I try to look past the numbers and understand the story. We're going to need the numbers and we need to make them work. Because, we're a bank, we're a business, we have shareholders, we take in deposits and we lend them out. Right. And so we need to make sure for our customer base and our shareholder base that we are making good, sound decisions and that we're not going to have a bunch of loans go bad. Right. So yes, the numbers do definitely matter. And there's certain, things that, stand out to me when a business comes prepared with financial projections and business plans and different things like this. Do I look at them in super big detail and make sure they have a 30-page business plan? Absolutely not. But if you've gone through that exercise, it tells me that, you are really invested and that you've taken the time to do that. And you're not just, your strategy isn't hope, right? Again, situationally, it may be different. But when you come in prepared and you've got, a story along with the numbers that can make sense of it, that's how we get things done. So
it's kind of interesting. So one of the most common dominoes that we see when we start working with a new company is we'll look at the quality of their financials. Usually is the first place we start, and whether we refer that out to a CPA firm, an accounting firm, bookkeeping. We start by getting the numbers into higher integrity. Then we get into what are they trying to do with their company? And that looks like strategic planning. And usually the very next thing says, do you have the capital base to do it? So what are some of the red flags you see? Let's assume they've got the numbers in line. They got a business plan. They got some concept. They know what they're going to try and accomplish. What do you look for next as a low-hanging, as a red flag before you're able to really be a great partner for some of your clients?
Yeah, I guess in the example you gave there, if they've got the numbers and they've got kind of this plan in place, the next question where the people aspect of things comes in, because you can use AI, you can use technology to evaluate numbers, and it's the story behind the numbers. So it's okay, in your example, whether it's a startup or an early stage business, if they've got, these aspirations and they need capital to grow, okay, well, how are you getting to that revenue level or that profitability level? How did you come up with these numbers? And that's where the underwriting comes, the real underwriting comes in, because sure, you can make the numbers look rosy and it looks like it's going to work, but if we can't explain how you got to those numbers, sure, it's a major red flag, right? I need to say, did you go and do research to understand this is how many customers you've got, or that this market is ripe for this type of business, or whatever it may be. So it's this. That's the biggest thing I see missed is people see it as going through the motions to check the box, and they forget, gosh, this is really meaningful, and it can be meaningful for you as the business owner to go through that, even though, we'll use projections as an example. And I get a lot of people say, well, I don't know. Well, I don't know what I'm going to do. It's just a projection. It's a guess. And that's great. Well, let's have an educated guess, and let's run some hypotheticals, and let's run a worst case, middle case, best case scenario. And I don't want you to do it for me. Do it for you, as you know, because this is you going through hypothetical situations to understand is this going to be viable, or what happens? What's my fallback in the worst case scenario? And unfortunately, as a banker, that's kind of where we try to start with our underwriting, or where we try to look with our underwriting is what happens if things don't go as planned? What's our fallback on it, right? Because we need to get repaid. That's our business model. We're running a business as well. And so, you know, I always tell people, help me help you. Help me tell the story so that I can put it on paper. If we can't explain it, red flag, and we're going to have issues, right?
How often do you see businesses that don't have that connection to, I know how many customers to get to X number of revenue dollars? How often do you see the gap there?
It depends on the type of business. If you're working with a lot of companies that have been around for years and years, obviously they have a little bit of a historical backdrop to get to. So that's more of, okay, if you're seeing this major growth in the next few years, and we look backwards and it's been a decline, okay, explain to me what's changing that we're going to get, from that decline to this major growth that you're seeing. Because anybody can put numbers on paper and say, this is what we're going to do. And you can even look at data and kind of pull out margins. But yeah, if you don't have that plan in place, or that ability to tell us this is how it's going to happen, and it may not happen perfectly, right? But at least if you have that plan and it sounds reasonable, we can kind of get behind some of that. So, to answer your question, it depends on in a startup situation, mm-hmm. It's going to be different than that mature business, right? And so, in a startup situation, I think people see it as going through the motion and saying, well, to get this SBA loan, for instance, I need they're just going to require a business plan. They're going to require me to have 2 years of financial projections. And it's kind of seen as a check the box item. So they just go through the motions and fill out these templates that, these third parties might give them, and they don't really know what's going into it. So that's where it's kind of having the actual conversation with the person, and sitting down and saying, do I really believe in this person as a business owner, as a manager, that they've got the right plan in place to move this thing forward?
Interesting. So we're going to rag on the big bank just for a second. When they're doing an underwriting perspective, there might be an entire department that has to go fine tooth comb scrutinize a business plan and financial projections, versus with you, it's often you that's reading through it to discern it, because you have to make a recommendation back to your credit team about whether this is a good deal or not. When should someone start a relationship with you?
Yeah, that's a really good distinction, I guess, if you want to compare, and instead of call it small bank, big bank, let's call it community banking. I'm an advocate for community banking. I worked at a larger national bank, and you're right. It's siloed there, where you've got salespeople and front end people, and then you've got, underwriters on the back end. And the two are kind of disconnected in a sense. The salesperson is out and they've got goals just to do, to bring in business, and then they throw it at underwriting and then they see what happens, right? And a lot of times that's not great, unless you have a really, really strong business that, you can take anywhere, which is the case, and which is great. Then you maybe want to, go out and get quotes from a few different banks, and, you're kind of competing for who can give you the best offer. But the community banking model is most of the, we'll call them commercial bankers, or the people who manage the relationships, that point of contact for the business owner. Most of them come up through the credit ranks. So a lot of times what that means is they start as maybe a credit analyst or an underwriter, and they learn how to, go through and read financials and tell the story, and then they start to develop a portfolio, and that's kind of how they grow up into that space. So to your point, exactly, yes. When you're talking to a good community banker that's got some experience, they're going to be on the front end looking at that through the lens of their former, roles or, what they've done in the past as a credit analyst or an underwriter, where they try to get ahead of that. And that's very helpful for business owners because that quick decision making is key. If you're not going to get help from someone, you need to move on and find, the next best path for help, right? And you need to do that quickly. That model, just the simple model of community banking versus that large national bank model, in and of itself is great for the business owner to be able to get more, quick feedback.
So there's probably someone listening to this right now that's dealing with the situation of sales have gone a little soft. My overhead continues to expand a little bit more than I'd like, and now I'm in a cash pinch. Do they come to you when they're in a pinch? Do you want them to take some sort of action before they start that conversation with you? Because they're not getting return calls from the 1-800 numbers. So what should they be doing first before they call you?
Yeah, and the person listening to this in that situation is not going to like this response, but the best time to get money is when you don't need money. Mm-hmm. And I tell that to everybody. It's being proactive. Of course, when your financials look good and you don't need the capital, you aren't thinking about going to the bank and setting up things for a rainy day when the worst happens, right? And so, to answer your question, unfortunately, the answer is before you need it, right? And so, you need to get with your banker, and if you have got a good community banker, sit down with them and say, things are going really good right now. Here's some possible headwinds, some things that might be happening in the economy or in the local market that may impact my business. I'm a little bit worried about it. Let's get ahead of it. Is there anything we can put in place, whether that's a line of credit or whatever the planning is? Maybe it's as simple as you don't need anything in place right now, but if you start to see this come to fruition, let's talk about it before you're actually in the hole. Because my guess is that person that's in really good shape at this time, maybe sitting on some cash, and they'll have a runway to get through some challenge, hopefully some challenging times for, 3 months, 6 months, 9 months, a year, whatever it is that they've built up. But you need to get ahead of that, because once the financial statements start to deteriorate and you're not showing adequate cash flow to repay a bank loan, it's going to be hard for a bank to lend money at that point.
So let's go to the other side. Sales are strong. We're going up and to the right. We think we're going to do 20, 30, 40% growth this next year. And now I got to add some people. We haven't realized the revenue yet, but the sales are starting to come in and we're getting outstripped of our supply. So that's when you should help me, right?
Sure. Yeah, absolutely. Go ahead.
One of the things we see frequently is there's a bubble, and on the, oh crap, my overhead is still too high relative to my sales. That's a tough spot for a business owner. It's a tough spot for the bank. And then the other side of it is we're growing so fast and we have to hire so many people and we don't have the capital we need for it. Is the bank as confident about that situation, or would they like them better and more of a, hey, you've got some consistency, we can see you're growing and you're proactive ahead of it, or to the tip of it where you've actually you're over your skis at this point. We are still ready to take you on. We're going to move in quickly to help you get what you need for your liquidity.
Yeah, I mean, of course, a bank's going to like the former, better, right? If you ask what the bank likes better, of course, yeah. It's easier, right? It's easier to underwrite that. It's clean. And, yes, we're trying to build a portfolio of performing loans. We don't want to deal with collections and different things like that, right? We never want to get into that situation. Our shareholders and our customers, for that matter, that have their money on deposit with us would not appreciate that. So, but to your point, where community banks kind of shine is in that gray area, right? Where the larger national bank probably has a box that they're inside, and it says, this is our credit criteria. And if it doesn't fit, we don't do it. A community bank, yes, we'll have parameters, we'll have guidelines, we've got loan policies, just like, the bigger guys, but we can, you're at a community bank, our bank, for instance, has about 30 employees. You're able to talk to the key decision makers, the people that are making those decisions in the loan committees. So, for us, it's a matter of, okay, let's sit down, talk to this manager and understand, do they have a viable business? Yes, we need to look at some history, right? And we need to say, okay, you've proven that you can do something in the past. We know that you've run a successful business. You have it. Here's a bump in the road. Okay, yeah, the numbers don't look good right now, but we've got some history. And then what's your plan moving forward? And, that allows us to get through the immediate bump in the road if we've got history and we've got, a good future plan and somebody who's clearly, all in, right? Getting outside help from consultants like yourself, like CBC. I mean, when somebody comes in and they're in a bump in the road and you tell me that you're talking to them and they're sitting at a CEO roundtable, for instance, I put that in my underwriting because it tells me that they've come to realization that, they're bigger than themselves. They need help from other people, right? And if somebody can't admit that and they're just stubborn in their own ways, then, it becomes harder to trust that their plan is going to work, right?
And it's really interesting that you put it that way. How often we run into people who've been in business 20, 30 years at this point, and they have this story that at some point they're going to sell the business in 3 to 5 years. It's just there. But if they've never gotten outside help from someone to look at their books, someone to look at their banking partnership and their capital needs, what likelihood do you think, or how confident are you in them as a business to be able to make a transition or a transaction to hand it off to the next generation?
Right. And that's the reality of a lot of small businesses that we work with, that usually if I'm banking with somebody, we're going to have that level of conversation where they are going to be transparent and tell me that, hey, this is my plan, and if it is to sell in 3 years, somebody might look at it and say, well, why do we want to get involved as a bank if we know they're going to just sell the company in 3 years? Why would we want to take that risk? And so, you better have a good plan. Yes, I'm going to need to price it appropriately for me to in the banking business to earn the yield that I need to earn on that, to have it make sense in that case. But then it's beyond that. It's saying, okay, well, what's the plan? Maybe the transition plan is that it's going to go to another key individual that currently works in the business. And it says, well, okay, well, maybe I can help, get to know that person along the way, and we can help facilitate some lending for the buyout in that case down the line, right? And so there's some upside there about having those conversations, and having that level of transparency in the relationship.
So one of the things in the bigger organizations, it's always bottom dollar driven. Not always, but it's a big emphasis. What has the leadership team experience been like for you working with a community bank where there is a little bit more expectation of investment from the representation side? What's that been like?
Yeah, I've worked for technically 3 banks in my career. I've spent 8 years at a large national bank, and then moved to a community bank that grew to become kind of more of a regional sized bank. And then most recently moved to Riverland Bank, which is the smallest bank I've worked at yet. But again, a key part of the leadership team, to your point. And, we're able to have conversations and make decisions, with a snap of our finger, because, we've got that experience and that bench at the top with that leadership team. Sometimes it doesn't fit within the normal realm of what you might see or what you might like to see in underwriting, but there's a great story behind it, and we can have that conversation. Where when I worked at the larger institution, for that, it's kind of like it's got to go up, the red tape, and you don't get an opportunity to have that conversation, because they're so big that they say, you know what, we need to stay within this box. Once we get outside that box, if we start doing that, a lot can go wrong in a large bank. So I'm not disagreeing with their model, and there's definitely a place for it, but that's the benefit of us and the small business clientele that we serve. So
you've been through the transition of small business kind of growing to a regional bank size. Pros and cons of that. What does that look like? Why is that really good for a banking customer or a prospective customer to be saying, hey, I like what's going on there in case something should happen in the future? Why would that be a good thing for a customer who's looking at, maybe I should call this Brett guy?
Well, most customers that I work with are attempting to grow their business, right? the bank, what I remind people, the bank's a business too. And if your bank doesn't have a growth mindset, isn't attempting to do the same thing, to me, that would be a little bit of a red flag. We want to serve our community. We want to, continue the relationship banking mentality that is missing for a lot of small businesses. There's a gap in being able to take care of these small businesses. So, for us to have that growth mindset and say, we want to serve more of these customers. A lot of times for small banks, that means, you have to come together with another small bank, whether that's a merge or an acquisition or whatever it is. To me, that, yes, there's some pain points in that, but it gives a lot more opportunity for our customers, for us to invest in more technology, to serve more communities, to bring on more people and teach them, how we do business, right, as a community bank. So there's a lot of opportunity in that. I would think a business owner would want to be a part of that growth and grow with that bank.
Now, as far as the local economy goes right now, it's heavy. First quarter, we work primarily with trades, manufacturing, a bunch of professional services company. It's a heavy economy right now. Banks consolidating, is that a sign of the economy growing, contracting? What does that look like?
Yeah, banks have been consolidating for several years now. So I wouldn't attribute any of that to, hyper recent activity. I think there's a lot more technology that's out there these days. Things are more expensive to run. And for banks to continue to do what they're doing and having more competition from, non-bank online lenders or online deposit, folks, it's more expensive for us to compete. We have to lower our pricing on our loans. We have to increase our pricing on our deposits to compete with those sources, right? And so when you're really small, it's hard to do that, right? And so by two small banks coming together to create a larger bank, 1 + 1 = 3 because you get rid of some of the shared overhead, and you're able to kind of have some more dollars available through scale to invest in those things. Not to mention more people out marketing and selling the way that you do business. So I guess I wouldn't attribute it to, I think it would be happening regardless of the strength of the economy right now.
So Brett, one of the biggest reasons why I was interested in having a conversation with you is because you're one of the most personable people in the industry. And I actually got a note this morning from someone who I had introduced you to, who said, thank you for that introduction to Brett. He's good people. And it's been really cool to see how your reputation as an extension of my referrals has reflected back to what we're doing with CBC. So thank you for being that kind of a partner for us and for a bunch of our members that we work with.
Yeah, no, I appreciate that. And I guess I'd throw that back at you as well. I mean, I think, again, I alluded to when you send a referral over, I put that in our underwriting and proudly state, hey, Josh and his team over at CBC are helping this client to understand and uncover some things and think about things in different ways, right? Which, to me, our philosophy in underwriting is management. Yes, the numbers matter. I will keep coming back to that. The numbers matter. So I'm not just going to say you come in and you have a good story that it's a done deal, right? You need to have numbers to back it up, right? But management. So if I know that people are out there and they're consulting with good people like you and the folks at CBC, then again, same thing. It helps me to make quicker decisions. It helps me to know, hey, all right, this might be a little gray or, not a cookie cutter, approach to something, but I know that they're out there doing the right things and getting good advice from people.
So last couple questions here. Other than financials, what's the number one blind spot you see founder-led businesses wrestling with?
That's a tough one. I think, it depends again on everything is situational. So I keep saying that, right? Every situation is different, but something that we come across a lot, is business owners, for lack of a better way to put it, who sometimes will be utilizing a business that maybe they're trying to grow and they have the right mindset, but they're utilizing it as a purely lifestyle business and using the company as an ATM.
What does that functionally look like?
What that functionally looks like is, okay, the business maybe has grown at this point to it's self-sufficient. Maybe the owner's not really needed as much. Maybe they're more of a strategic advisor, or serve as a chairman on the board, or, whatever it may be, depending on the size of the business at that point. And they're, maybe they've got some good profitability, but the owner is going in and living a good life. And I'm not saying that they shouldn't pay themselves well and that they shouldn't be able to distribute their profits. But if you have what's your end goal? If you have an end goal of growing this company to sell, or, growing this company and passing it on to the next generation, or whatever that may be, building equity on the balance sheet by retaining some level of profits in the business, whether that's to help get through a rainy day, as we talked about, when there's an unforeseen bump in the road, not if, but when, because everybody's going to run into it. If you're blind to that and you take every last penny out of the company when it's doing well, and you don't build up that buffer and that cushion, you're setting it up for failure in the future.
How much cash should a business realistically keep on hand? Is it a dollar amount? Is it a measure of operating expenses?
Yeah, I mean, I don't have a perfect answer for that. I'll go back and say again, every case is different, right?
Come on, yeah. Brett, don't chicken out behind a situational answer.
It's not to get into ratios because I don't like to talk about numbers, but typically a bank's comfort zone is they look at, we look at what's called debt service coverage ratio, right? And it's basically, okay, what does your EBITDA, or your earnings before interest, taxes, depreciation, amortization, look like as compared to the amount of debt that you have to pay, right? Your senior debt service, or your debt service in that case, and that's your debt service coverage ratio. And a lot of times, a good target to kind of keep in mind that, if you're trying to be a bankable business, is 1.25, right? And so what does that mean is that you're going to have that 0.25 extra beyond the one-to-one coverage in your cash flow, is going to be available to put into a savings account or whatever that may be, right? And some of that may go to taxes, and there's some other things like that. But I recommend that whether you're, for a business regardless, because you brought up a good point of, gosh, now I need capital to invest in people, or now I need to buy equipment, or, whatever it may be for that next thing. Now at least you've got a starting point and some base capital that you can utilize to go to the bank and say, okay, I've got a little bit of capital saved up, but I need some help with some more of it. The bank's probably more prone to give you more money in that case, because you've been conservative with your cash. You've built up a little nest egg. I would rather give that business a loan and have them reserve some of their cash and move that over so that, we have that again for that rainy day situation. And then, provide the debt, for more in that case. But a lot of times, if the owner's taking every last penny out, distributing all the profits, not keeping any equity in the business, I alluded to something earlier called fallback, right? And it's like, where's the fallback? Okay. If the owner is going and, putting all of this money personally and they're personally guaranteeing, okay, we could argue probably in underwriting that there's fallback on the personal guarantee from the owner. But, let's say the owner is going out and buying, a bunch of boats and cars and vacation properties and whatever else it is. And they aren't reserving a lot of that money. So now it's like, gosh, I don't have a lot of fallback. It's hard for me to get to fallback, because if something does happen, that's what we're underwriting to as a bank. We're underwriting and saying, what happens? How do we get repaid? How do we get our money back so that we don't have to go back to our customers with a loss on our, at the bank and say we lost on this because we made a bad decision. And it comes down to that fallback, question. And so that's where a long-winded way of saying I do see that too often. I most of the people that I work with aren't in that situation, but I do see that too often.
Couple of examples here. What's a situation where you had to tell a client no?
I don't like to say no, Josh. I am a yes man.
Careful, you're going to get called from a dozen to 100 people now.
Hey,
You're
that's
like,
fine. That's
I
fine.
need money. I need money, Brett.
I don't say no, but I say, maybe now is not the right time. Or, here's what we need to do to get there. Here's a partner. A lot of times it ends up being a startup business. Startup businesses are tough to bank. There are ways to do it, and I've done it. And I've got some very successful ones that I've banked for years and that now are really good, strong, valuable businesses. But a lot of times they come in and they say, well, here's my business plan. I don't have a dollar to my name. I don't have anybody else to come in and invest to support it, but I know this is going to be successful. Take my word for it. And I'd love to. Like, a lot of times these are great ideas, right? And I'd love to just be like, gosh, okay, I'll invest in that, right? But at the end of the day, you need fallback. You need to to prove it first, and that's just kind of the model of banking. And if it's not bankable at that point, if there's no fallback, and you don't have anything there, then it kind of comes down to, okay, do you have some other assets that we can put on the table to kind of help us get over that hump? Because I believe in your story and your plan. But maybe it's, we need to take a lien on the house to kind of help us get comfortable with that, unless you're going to go, if you want bank debt again. But if that's not an option, then maybe we got to introduce them to somebody who's got private capital or an investor who might look at that and say their fallback is they're going to take equity in the company and they believe in it enough that they're going to be able to take that and package it into maybe their other investments and make money off of it. So there's again different solutions depending on the different situations, and sometimes bank debt is not always the right one.
Demystify the personal financials statement. Give a little bit of color of, hey, what someone should expect when they're going to come ask for money. What kinds of things are you going to ask them for in that process?
You mean like a personal financial statement on the owner?
Correct.
When we ask for that,
yeah.
And people get, kind of leery of providing their personal financial statement.
Yeah. Why is that important?
Yeah, I think I alluded to it a little bit before. If you've got a business and you're draining all the capital out of it as an owner, and then burning it in Vegas or wherever it is. We'll see that on the personal financial statement. So again, management, which comes down to what? Character, right? And so I'm looking for good character, good people. That's who we want to do business with, because I need to be able to have a conversation with this person. They need to be transparent with me. I'm going to tell them exactly what I'm looking at and get ahead of things so that we don't have issues. And, that means, I need to look at, your personal financial situation and understand, hey, are you, personally, struggling and up against the wall? I need to understand that, because that will impact your business, because then now maybe you are forced to have to distribute that money to make ends meet personally. And we need to put that global picture together to understand it. Because again, I'm running a business as well. Right. And so, on the flip side, in a positive light, a lot of times I'll see a business that maybe isn't super strong, but then you look at a personal statement and you say, gosh, okay, this person has really good personal credit. They always pay their bills. They don't have a lot of credit card debt. They manage themselves pretty frugally and pretty conservatively, and that builds character, and that builds something, for our underwriting that we can lean on. So, it's definitely, we need to be transparent. You're selling yourself to the bank, and you need to brag about yourself a little bit with a personal financial statement and provide that, right? So,
Brett, you make it very easy to want to refer more clients to you once they get through a couple stages of getting their books cleaned up and get a little bit of a plan around their expectations. It's so easy to send folks your direction. Any other final thoughts, things we're leaving out that we should mention?
No, I can't think of any. I mean, I think it's... I've really enjoyed working with you. I mean, I want to throw that right back at you and say, you bring people to me that you've already had a lot of these conversations with, and they're prepared, which makes my job a lot easier. So thank you for that. And obviously we want to return the favor and get as many of our customers that need that consulting help in front of you as well. So.
Thanks for being part of this, Brett.
Thank you.
Another great episode with CBC Talks. Brett Howells from Riverland Bank. Thanks for being here.
Thank you.
If this conversation is resonating with you, it's probably because you're the kind of leader we built the Creative Business Council for. Our peer groups are designed for owners and leaders who want more than just ideas. They want accountability, clarity, and the chance to sit at the table with people facing the same challenges. The Creative Business Council is looking for leaders like you. Sit in on one of our peer groups and see the difference for yourself. Just click the link in the description.